Okay, good afternoon, everybody, and welcome to the second installment of our financial planning webinar series. Today, we'll be speaking to you about the importance of organizing the ways in which you will draw income in retirement from your different accounts. Today's webinar is hosted by myself, Daniel Mesa, financial advisor here at the firm.
Nicholas Mauricio, financial advisor here at Skybound Wealth.
And Michael Jordan, senior financial advisor.
So before we begin, please see some disclosures below. In summary, nothing is to be taken as a recommendation or solicitation to purchase or sell securities, nor to be taken as direct investment or tax advice.
So some key takeaways that you should walk away with from today's webinar are how to understand your financial vehicles and typical account types for retirement, how we can structure these resources to potentially mitigate taxes to and through retirement, and overall enhance the longevity of your portfolio for you as well as for your beneficiaries.
In today's conversation, we'll discuss the following: typical retirement income sources, the importance of having a sequence of distributions plan in place. To put everything into perspective, we'll go into a case study, and within that case study, we'll illustrate to you the impact of having a distribution plan as opposed to not having one. And we'll highlight the next steps or the steps that you should be taking now to be better prepared. And finally, finish off with a Q&A session.
So before we can get into determining what the sequence of distribution should be for any one of our clients, the first step in the planning process would be to determine and assess, what can be utilized in terms of sequence, the investments that you have or acquire, that where you can draw an income down down the road. We are going to take a brief look at some of the income sources that our clients typically will utilize in their personalized financial plan, starting with secure funds, qualified and non-qualified US accounts, international pensions, and real estate. Excuse me. When we speak of secure retirement funds, we are actually referring to US Social Security, UK state pensions, and annuities. Having an accurate forecast or projection will form the basis of our conversations. This is one of the reasons why we've included the website links for your reference. One difference in the UK and the US between the state pensions is actually when you can start the pensions. In the UK, it's linked to your date of birth. So someone born in 1966 would have a start date of on their 67th birthday. Whereas the same person in the US can select their pension start date as long as it falls between 62 and 70. Government pensions are often forgotten, discounted, or not generally relied upon, more so the UK state pensions, to be fair, given its size. Understanding what proportion of your retirement income is stable or guaranteed is a fundamental part of our cross-border financial planning process. Those who are contemplating early retirement will have a greater peace of mind knowing that there is an income source that will outlast them. Certainly, knowing when it's optimum to take your US Social Security or UK state pension can increase the probability of success in achieving your financial goals, especially when you're cashing in your financial final salaries. For those persons, for those persons that are contemplating when to leave the US permanently to return home, knowing how many credits you have to be eligible for the US Social Security could help determine your departure date. Unfortunately, it happens far too often where people decide to leave the US before they've achieved their full credits and consequently end up leaving a lifetime worth of income on the table. In summary, understanding what your income stability ratio is will help you make an informed decision, provide confidence, and know that your target date is indeed your target date, no matter what life or the markets may throw at you.
Now we will take a look at US-based account types. Typically, they fall under non-qualified or non-qualified. A qualified asset is one that has a direct tax advantage in one of two ways, pre and post-tax. First, we'll take a look at 401ks, 403bs, IRAs, those that most of our clients tend to have in their financial plan. All of these account types are known as tax deductible or pre-tax accounts. By this, I mean if you, for example, made $100,000 in 2021 and made a contribution of $10,000 to your 401k, you'd be taxed on $90,000 worth of income. All of these assets sit and grow tax deferred based on your risk tolerance. And typically, you will not be able to access them until 59 and a half without any penalty. And when it comes to drawing these assets down, it will be taxed at your income tax rate in retirement. And one of the most important topics we analyze approaching and in retirement is RMDs, or required minimum distributions, at which of the age of 72, you are forced to pull income based on a calculation from the IRS, calculation from the IRS. And because most individuals are unaware of this rule, they may have an increased income due to this in later years, forcing them to pay more in taxes than necessary, and even eroding their overall portfolio. In our financial planning, we will stress test this and strategize ways to mitigate the impact of RMDs and what they might have on your overall portfolio. Next, we'll take a look here at your post-tax accounts, typically seen as Roth 401ks and Roth IRAs. And by post-tax contributions, we mean you have already paid taxes on that income and then contribute to these accounts. And all of these assets in the Roth structure grow tax-free. And when you decide to draw that income from these tools, you will not have to pay tax on any of that income down the line. Additionally, just as with your 401k and other qualified accounts, you will not be able to access before 59 and a half. And one of the most vital benefits of these accounts are no required minimum distributions. So for most of our clients, we take into account the size of these assets and help determine strategies for optimal drawdown. One last thing to note here, for 2022, the IRS has just increased the 401k contribution limit from $19,500 to $20,500 if you're under the age of 50, and $26,500 to $27,500 if you're over the age of 50.
So non-qualified accounts are accounts that we typically see, your brokerage or investment accounts. These accounts have no direct tax advantage and therefore have no access or contribution limits. So the taxation of these accounts will ultimately be based on how long you held the assets before selling, and that will then be classified into short-term capital gains or long-term capital gains. The difference is if you sell within a 12-month period or not. Taxes on short-term gains are based on your income tax bracket. Taxes on long-term gains are taxed at 0, 15, or 20%, and that will depend on your income. So now in retirement, it's very important to understand your capital gains or losses and prior to making any sales and the potential for tax loss harvesting in those accounts, especially prior to the deadline for tax loss harvesting, which is the 31st of December every year.
Another income source is international pensions. The most common types are DCs, which the abbreviation stands for defined contributions, aka money purchase. DBs, defined benefit, aka final salary. SIPs, self-invested person pension. QROPs, qualified recognized overseas pensions. And last but not least, QNUPs, qualified non-UK pension scheme. The common features between these various pensions revolve around tax deferral and growth. Early access dates, typically 50 to 55. In terms of benefits, taxation on distribution only, withdrawals that, are taxed at marginal rate of income and not capital gains. No RMDs, except for DBs where there is a normal retirement date. And of course, if indeed you left the US, the opportunity to manage those US-based assets as well. When we are creating financial plans for our new and existing clients, we often consider the need to transfer or consolidate these types of pensions. What flexibility and control they provide, if any, in a holistic plan. How can we utilize the lifetime allowance to your advantage? And of course, how can we utilize these pension assets when building the drawdown strategies where variable income is required through your go-go, slow-go, and no-go years in retirement? Excuse me. In terms of real estate, certainly a topic that's near and dear to my heart, we focus on physical property. In this instance, it's single and multi-family residential investment property. The main features this type of investment offers is that it's physical. Some people like that. Income and capital growth potential, personal, corporate, and corporate ownership, and it's often considered lower risk. In terms of benefits, the property can be placed in an international pension, and in doing so, provide an opportunity to defer any income tax liability until you take distributions, as well as capital gains tax or CGT mitigation. That is crucial in terms of when we start to look at people's existing assets, particularly if they've left the property back in the UK and building in a drawdown strategy. But in addition to that, wealth building, portfolio hedging, that's utilizing the income as it's not affected by what's going on in the volatility in the markets. And something that's increasingly becoming more talked about and popular is finance, and particularly leveraging your assets under management to secure interest-only financing. So indeed, you're a cash buyer when you're out there looking for deals.
Now, what is the sequence of distribution? As we've reviewed up to this point, building wealth in multiple assets is robust and can be done in many different ways leading up to retirement. And while building a financial plan, we must know how you are to draw out that income from these various sources. So the order and timing in which you draw from the accounts is what we call a sequence of distribution. As we have seen in the above slides, we must first understand the types of accounts, accessibility, and location of these accounts to determine which one we should access first. Then we will assess the timing of withdrawals and how drawing from one account for another could result in a more efficient drawdown strategy. And a general order of withdrawals that we might implement for a client's plan might be as follows. Non-qualified assets first, as there are no age limits from which you can access. And for those of our clients that wish to retire before 59 and a half or 55, they will not be limited. Then US qualified accounts, because we want to limit the required and minimum distributions, which we covered a little bit earlier, and by the time the client reaches the age of 72. Then international pensions, if DTA applies, as they have no RMDs, required minimum distributions, but certain pension pots have tax-free death benefits until the age of 75. And finally, Roth accounts in real estate, as they have fewer restrictions from when you can access. And additionally, Roth IRAs and Roth 401ks create tax-free income, which could be vital in the later years of retirement. And again, this is not a direct recommendation each client's financial plan is different from where they desire to retire to how much they have in each of these accounts. So for the remainder of the webinar, we'll dive into a sample case study as to what that might look like for any particular client.
So again, to put it all in perspective, we're going to present to you today a case study of a family who's amassed wealth both in the US and the UK. As many of you have seen our previous webinar, it's the same family, the Smith family. And this is a case study where many of our clients fall under. So again, have amassed considerable assets, feel comfortable, but we're going to highlight some ways where they can add efficiencies. So to give you the background, John is 52, Joanna is 46, and they have a 12-year-old son, Graham. They make a total of about $320,000 as a household and aim to retire in the US when John is 70 and Joanna is 65 on about $250,000 a year. In terms of assets on the US side, they both have active and dormant 401ks and IRAs, their main property, some cash savings, and have both luckily already qualified for Social Security benefits from about $4,000 if they delay to the age of 70. On the UK side, John had a defined benefit pension for which he accepted the lump sum or CETV offer and placed it within a personal pension or SIP, which is a UK equivalent or very similar to an IRA here. And Joanna consolidated her multiple dormant defined contribution plan, so similar to dormant 401ks, into a SIP, again, like a personal pension here in the US, and they have a property that they inherited from a family member. So the point to note here is that they have many of the accounts that we've already touched on within the presentation. And luckily, they've already taken action on their UK pensions and taken them under the control because it was assessed that long-term, it did suit their longer-term needs. However, they're yet to address the amount of money that they will have in their 401k and IRA accounts and how that can ultimately affect them. In their case, given the current income and their age, we can very easily see the valuation of these qualified accounts increasing significantly by the time that they retire, given their contributions and future potential growth. So let's take a look at what would happen if the Smiths, again, feel comfortable, they have amassed quite a few assets, if they did nothing. So if they continue to save, continue to invest, but made no changes in their account structures, we would see that, given contributions and an average rate of return, their 401ks and IRAs would have a value of a little over $5.5 million by the time Joanna is 72. And the reason why we're illustrating the age of 72 is because it's the age at which they will both be forced to take their RMDs from these qualified accounts. And without having built an effective sequence of distributions, their RMDs when Joanna is 72 are going to be about $235,000, which is about 100% of their desired income. And keep in mind, this doesn't take into account their Social Security benefits and other account withdrawals. And what this would then cause is for them to take more income than needed and pay a higher tax rate. So by making sure that you only take out what you need from your accounts in retirement, you would increase the longevity of your portfolio, which is important. But I think very looked over is the amount that you would save in taxes that you pay over your lifetime. So let's see at what the Smiths can be doing now to solve for this.
So in this instance, it was determined that a Roth conversion strategy that started today would reduce the required minimum distributions and the subsequent tax on the income that would become due also. Using financial planning calculators, we can quickly illustrate potential outcomes if recommended plans are implemented. And in this case, the RMDs have reduced from 235,000 to 149,000. That's basically a reduction of 85,621. This is key as it is closer to their desired retirement income. And please note that all of our clients who have interactive plans will have the access to this and many other calculators via our secure client portal. By systematically moving their qualified assets into Roth IRA or Roth annuity IRA would reduce their taxable income on distribution. This will also benefit from tax-free compounded growth, as you will see in the next slide. In this case, using the Roth conversion strategy, John and Joanna were able to reduce their gross taxable income at 72 from 482,675 to 351,248 per annum. The income has been indexed to combat the effects of inflation, just in case you wonder. This means that they have reduced the amount of income subject to tax and in doing so fallen into a lower tax bracket. The base tax total income rate has moved from 23% to just over 19%. This equates to a tax saving of 44,771, approximately 60% in just 1 year alone. Please note that we have clients who have a level of income that normally would prevent them from utilizing Roth directly. This is not the issue with us, as we have strategies where it would provide a direct path into the Roth from, for example, existing 401ks of their current employment. There's an opportunity to look at in-service rollovers, as well as access through traditional IRAs. Having the ability to run these scenarios in real time with our clients goes a long way to cover the what-if outcomes and help them to visualize the real cost of delay.
As we discussed there in the previous slide, we determined that by efficiently managing your sequence of distributions, or John and Joanna's sequence of distribution, we could potentially mitigate income tax in retirement while they're alive. Some of the other considerations that we take into account when building a financial plan is what happens when you're no longer here, and how can we maximize your overall estate. In this specific example, we see on the left in the current scenario for John and Joanna, that they will leave behind roughly about $10 million for their children, and will have to pay about $1.9 million in taxes to pass those assets down to that next generation. By implementing the strategies that we discussed up to this point, the Roth conversions and other strategies as well, we have effectively increased their overall net to heirs to about $12.9 million, but also minimize the tax bill by $1.2 million to about $750,000. For those of our clients that wish to leave behind a legacy, and a strategic approach to sequence of distributions could be millions more for them. One last point that we take into consideration for this is the regulations and reforms that are currently in place or that will be in place. And as for right now, the US federal estate tax limit or exemption is $11.7 million per person. And in this specific instance for John and Joanna, that wouldn't be a problem for them. However, in 2026, that rule is going to what's called sunset, and reduced to about $5 million adjusted for inflation, changing the potential tax liability for John and Joanna in a major way, exposing them to a higher tax limit for their estate.
So I guess the main action that we would encourage you to do is to ask yourself some pertinent questions. We've got a handful here to help you. Essentially, you need to consider whether or not you have a financial plan and it's geared towards the subsequent changes that life often throws in your way. You may want to know indeed if you are on track to your identified targeted goals. In terms of investments, it pays to know where they are and how indeed they are working for you, and if indeed any changes need to be had, and so on. One of the key questions would be, will your estate and beneficiaries be impacted due to the upcoming changes in exemption that Nico mentioned? If the answer is no to any one of these questions, then I urge you to get in contact with the person that's invited you to get onto the webinar today, or indeed if you're already working with one of the Skybound advisors.
So for those of us who are not familiar with Skybound at the moment, how does working with us look? We'd first, before we begin creating a financial plan for our clients, we'd gather information through a fact-finding process with you, which goes in depth as to your goals and current circumstances. We'd assess, again, your situation currently and the longer-term goals. We'd work in conjunction with our paraplanners and our investment team to prepare a tailor-made plan or report for you. Following this report, we would ultimately begin to implement the plan for you or with you. And finally, once the plan's implemented, we'd monitor that with you on a regular basis and discuss it with you during our meetings, because life isn't static, right? So if there are any changes, we have to take those into account in the plan. In creating your professional team, we of course appreciate that many of our clients, or if you're not a client yourselves, you're working with other professionals. We work or we aim to work alongside them as part of your team, and whether that be a legal, tax, or any other professional. In terms of the Skybound fees, there's a variety of different ways in which Skybound would make a fee, but typically we charge a percentage of assets under management, or if someone simply wants a plan built, we would charge a financial planning fee. And all the fees prior to committing to becoming a client or taking any advice on are shown to you prior to, again, committing, and are all outlined in our ADV brochures. So we'll go into now the Q&A session. If during the webinar your questions aren't addressed, or you're watching a recording, please feel free to email one of our paraplanners, Belen. Her email is on the screen. So I'll go ahead and ask one of the first questions that's come in on the box. If you do have questions right now, please go ahead and input them on the Q&A box on the bottom. So the first one is, I make too much money. Shouldn't I wait to have a lower income to make Roth conversion? Nico, go ahead and take that one if you want.
Yes, so again, great question. It's a common misconception here as income, there are income limits for those who make above a certain tax bracket or an income limit there, that they won't be able to directly contribute to a Roth IRA. However, there are some strategies that we have implemented in the past that allow us to convert IRA assets today and in a phased structure, reduce some of those taxable liabilities, improving the overall plan, such as backdoor Roths and things of those natures. Again, depending on the income tax bracket, but those are things that we still can be able to do today to get prepared for that, required minimum distribution down the line. Some other questions that we have here as well. What if I'm going back to the UK? Does the strategy change at all? Mike, I believe that's going for you there.
Yeah, the long and short of it is that even if you went back to any other jurisdiction outside of the US, the big thing that we need to consider is the dual taxation and how it would treat the current assets and financial plan that you've left behind. Typically, your 401ks, your IRAs, etc. Excuse me. The thing that's most frustrating is that clients that are not working with us often contact us when it's imminent for them to leave. And at that point, our hands are somewhat tied as to what we can do to affect a strategy. So the important thing is to understand the timelines before you go. But the long and short of it is that with a robust strategy, it should already take into account some of the variables, and that's the beauty of having an interactive plan. So hopefully that answers the question. I'm just checking. So what split of funds should you take from UK versus US investment funds? Yeah, who wants to take that? Nico?
Yes, again, great question. When it comes to US to UK having assets in both domiciles there, in the early years of the retirement, we should aim to deplete the US funds as we saw in the cash flow above. By having less of those assets in the later years, you could potentially reduce some of that tax liability, but also over time, if you're deciding to retire here in the US, we'll tend to phase some of those UK denominated funds or GBP denominated funds into US dollar denominated funds for some of those latter years there. Hopefully that answers your question there. We're having some other questions here come in. 1 second there. Do we need to take distribution from SIP in sterling to UK bank account and then switch into US dollar for the transfer to the USA? If you're retiring here in the US, I guess, Dan, would you want to take that one?
Yeah, sure. So distribution from SIP in sterling to UK bank. I mean, ultimately, it will depend on what you need. If you need income in dollars, ideally, if you're working with an advisor over a longer period of time, they would have over time, as the exchange rate is favorable or simply on your choosing, but hopefully with some advice, not just an emotional decision, you would go from sterling denominated funds into dollar denominated funds so that you're still invested. And then at the point where you need to take distribution from the account, you could simply sell some of the positions, generate cash, and that cash is then transferred to your US account. And the same would apply if you went elsewhere. So if you went back to live in the UK or in the Eurozone, you'd do the same thing. You'd go from sterling to euros or dollar to euro, whatever combination thereof. But ultimately, it'll just depend on your income need and jurisdiction in which you're going to need it, or the currency in which you want that income. So I can't see the question box here, guys, but are there any other questions that have come up?
Yes, another question here. Can I make Roth contributions if I am maxing on my pre-tax 401k? Mike, did you want to go ahead and take that one as well?
Yes, so we touched on this briefly in the presentation. You're quite right, there are limitations to income to utilize a Roth directly. There are mechanisms, strategies that we can use that will allow you to still contribute in by using either an existing 401k subject to the permissions of the employer. We have the ability to manage those assets in place, or indeed outside of that, if you have any standalone Roth IRAs, traditional IRAs. Again, what we would do is walk you through how to do that systematically without triggering any taxable events or mitigating any tax in some instances. So hopefully that helps you there.
Yeah, let's go ahead and take one more in the interest of time. And then for any questions, guys, that have not been addressed directly, we will make sure to email you the responses, or if you had detailed questions or hadn't had a chance to type it in, feel free to reach out to us via email or to your advisor. Go ahead, Mike.
So is a question here relating to tax-free lump sum, the 25%. So just a couple of things on that. I think I'll answer it just for the sake of time. In a nutshell, it's often referred to as the tax-free lump sum. But if you have a defined benefit pension or final salary pension, typically it would not be 25%. It's an amount that the trustee determines as opposed to a percentage of a balance of funds. But if indeed you have the pension under your control, maybe in a defined contribution type pension or maybe a SIP, 25% would be of the value at the time that you're taking it. But do remember, within the many solutions that we have, you can take a series of lump sums. So with that being said, the thrust of your question is it taxable in the US? With a robust dual taxation treaty that exists between the US, between the US and the UK, those funds will come in without any impact on your income tax. However, if you're fortunate to have a pension pot of a significant size, there could be extra tax to pay on exit of the UK around lifetime allowance, which is basically a maximum limit that the UK government has, where they will start to apply a higher tax rate for for you having the audacity to build a fund of that size. So hopefully that answers that question for you.
Perfect. So again, anyone who has additional questions, feel free to reach out to us or email Belen on the email on the screen. So that will conclude our webinar today on the sequence of distributions. I think you can appreciate it's a general summary. It can go into a lot more detail. If you do have questions in general, feel free to reach out for a consultation. We're happy to spend some time with you and explain our take on your current circumstances. So that concludes, again, today's webinar, and Nico will go ahead and invite you to our following webinar coming up.
Yes, again, thank you for taking some time today. We are hosting another webinar coming up in the 20th of January next year. We'll be talking about 401ks and IRA strategies before the end of the tax year, again, making some catch-up contributions, and what does that look like from an overall financial planning perspective, and really making sure that we're getting everybody prepared for that on that side of things. But other than that, thank you guys very much for taking some time today.
Thank you all.
Thank
Bye.
you.